Hey everyone, this is Katie Majola from Gen Z Tutors. uMajola umchunu umacingwane uyeyesa uphakathi ngqolungu wena wasengunyameni uphakathi akagugi kuyozoguga iy'ngane zakhe mabuya ngomthungwane bafukuzane bebiya ngehlathi jama kasilwane nyokane kuhlaza mabona bulawe awundaba ezitha. Let's get into it, guys. Today we're going to be tackling debentures, right? So today we're going to be tackling debentures. Okay, I had to repeat that. I received a question paper from the students that I was having the bootcamp with, and then they requested for me to actually go through this question paper and give them the responses and stuff like that. So now we have our required overhead down here. This is the first thing you always look at whenever you go to a question paper, right? That's how I always tackle question papers. But before we get into the question paper, I'd like to outline a few things, right? Firstly, is that when we have shares, we can actually say when we are issuing shares, excuse the English over there. Whenever we're issuing shares, what might happen is that we might be afraid that the shares that we have will not be fully bought by the public when you're having an initial public offering or something like that. So now what do companies actually usually do is that they will actually go to a bank or an individual or a certain other company that they will ask and say, please be our underwriter. An underwriter is somebody, underwriter is someone, is an entity, let's just say an entity instead of using someone, is an entity that is willing to serve as security to purchase the shares, if ever I can put it in a sense, right? Purchase the shares or debentures. Shares or debentures. What do I mean by that? Is that an underwriter will come and say, we'll go to the underwriter and talk to them, and then they will say, fine, whatever shares that we have in the company that we are issuing, let's say we are issuing 1,000 shares or something like that, they will say to us, they are willing to say they will secure this 1,000 shares that we are issuing, so that if ever it happens that the public actually subscribes the shares, maybe let's say they purchase 900 of the shares, then the underwriter will be willing to say, okay, fine, the remaining 100 shares they will be willing to pay for them, or debentures or whatever it might be, or preference shares, they will be okay to purchase them, right? And then also there is different types of thingy underwriters. So there's two types of underwriters. Type number one would be the full underwriter. Now a full underwriter would be somebody, an entity that would say, okay, fine. They're gonna actually be willing to cover the whole 100% if ever nobody ever buys it. So it means willing to cover or purchase just the whole 100% of the shares that will be remaining after the public has subscribed. Right? This is subscribed. This is the full underwriter, which they'll be willing to cover all of the shares if ever nobody ever buys them. But now we also have to remember that underwriters will have to say, okay, fine, I'm going to be willing to cover all of this, but it will come at a cost. So now that's whereby we come into the state whereby we have to actually pay a certain fee to the underwriters, which should be their commission, and that commission can be a certain percentage. can be 2%, it can be something like that. And also, again, you need to take note that if ever they're fully underwriting the shares, it means that if ever we are issuing 1,000 shares, they will say the underwriters commission will be this 1,000 shares multiplied by the percentage of the share, the percentage of the commission that they are charging. So now the percentage will be, let's just say 2% multiplied by 2%, right? And then they'll be getting a discount, basically, in some sense, of what, 20 rand, yeah, basically 20%. And then basically, depending on how much you are issuing the shares, also again, it will be what, let's just say you're issuing each share for 5 rand. So now they will get what, 100 rand. Basically, this is the 100 rand that will be reduced from the amount that they will have to pay us, or we have to pay them 100 rand. So we'll just offset the amount eventually. Even if the public actually ends up saying, okay, they were going to buy 900 shares, the public buys 900 shares, and then the underwriter actually only purchases 100 shares from us, right? So this will be the situation whereby the underwriter purchases what, 100 shares. So this 100 rand over here will be for what, the commission that will be, this will be the commission that we are supposed to pay the underwriters, right? This is the commission that we have to pay the underwriters, which will be 100 rand. But also at the very same time, the underwriters will still pay us and say, fine, yeah, we are subscribing for what, 100 shares. We ended up subscribing for 100 shares, so they'll be owing us 100 shares multiplied by what, we said we are issuing the shares for what, for how much, for 5 rand, right? So now this will be the situation that they'll have to pay us 500. But since we already owe them 100 rand, this will mean that eventually the underwriters, or the underwriters, will actually eventually offset the commission from the amount that they are supposed to pay us, and eventually pay what, they'll pay us 400 for our 100 shares. So I hope we're all in the same page at this point in time. Let's say total value of the shares, and then the remaining amount that we'll actually receive will be what, from the public. Then the public will pay us what, public, this is the public, they will pay us how much, the amount for the 900 shares, which is what, 4,500. And then the actual share capital will be, share capital will be what, this 4,500 plus the amount that we'll receive actually from the thingy, from the underwriters. Then the shares will be 4,900 instead of 5,000. I hope we're on the same page on that. And then that is for the full underwriter. And then secondly, we will have a second type of underwriter, which is what, a partial underwriter. Even though the partial underwriter is not here on this particular question, but it's fine. We'll just go and write it either ways, so that you guys understand it next time whenever you meet something like that, right? And then a partial underwriter will be an underwriter that will do what, willing to cover a certain portion of the shares after the public has subscribed, right? After the public has subscribed. That's a partial underwriting. Now it will be a situation whereby it's still, we are issuing what, 1,000 shares, but now on this 1,000 shares, they can say they are willing to underwrite only how much, maybe let's say 50% of the shares. So underwrite 50% of the shares, 50%. So now, if ever they're underwriting 50% of the shares, the commission that they will be receiving this time around will actually be different, right? Since now they're only underwriting what, 50% of the shares. And then we will go and have to say to them, okay, fine, your commission now this time around will be, this is the commission the commission will change to from being 100 rands to being this time around the total shares, which is 1,000 shares, and then multiply it by what? The 90% that they're underwriting. And then we can actually say now how much are the shares being issued for? They're being issued for 5 rand per share. And then we say these people are underwriting what? Thingy. Oh, sorry, I think I made an error there. I said these people are underwriting what? 50% of the shares. So that's the 50% of the shares. And then for each share is actually what? 5 rand, right? So now that's when you actually thingy. Oh, sorry, almost forgot one other thing. The underwriting 1,000 of these shares, only 50% on those 1,000 shares, they're only underwriting 50% of the shares, which each share is actually what? How much? Thingy, 5 rand, right? So that will be the situation. And then you said the commission is how much? 2%. That's the only thing that was missing. Then the commission, did we use 2% for the commission? Yes, it's 2%. Let me just do this. This is 2%. And then now their commission will be what? 50 bucks. So now, and then if ever, let's just assume everything goes out the very same way that it happened before, and the public actually purchases what? 900 shares, and then we actually, the only shares that are left is what? 100 shares. So now here's the difference. Now you'll have to take note that now I think the value of the shares that the underwriter will take will be equals to what? That remaining 100 shares multiplied by what? By 50%, because they were only willing to cover what? 50%. You understand? They were willing to cover 50% of the shares. So of whatever is left, they are willing to cover 50% of whatever is left. So this is the situation we'll be dealing with. So they'll be taking what? 50% of whatever is left, then multiply that by what? By 5. And then this time around, they'll be owing us thingy 250 for the shares, right? And then the amount that they will pay us will be what? That 250 for the shares that they owe us, and then minus the commission that we actually are thingy, minus the commission that we are actually supposed to pay them. So they'll end up paying us what? 200,000, 200 rands, and then the amount that we'll receive from the public will remain the same. So now there will be this remaining the same. Right, and then also at the very same time, now the total shares that will actually the actual total value of the shares that will be left behind in the end, it will be what? 4,500 plus 200. And then this is the difference between a partial underwriter and I think a full underwriter, right? And then also at the very same time, it might happen that the underwriter is not willing to circle and say, nah, I will take only the shares after the public has taken the shares. They'll be like, no, we are interested in this company and the company might actually grow. So we want more. We want to be put as first preference in a certain case. So now this is where we go and start saying, okay, also under underwriters, okay, let me get a charger first before we continue. Right. Right, they might be saying no, they're actually interested in the company and want to be put as first preference, right? And now in this particular situation, what would we do with them? Then there comes the part of saying the types of underwrite okay, as much as we said types of underwriters, then this situation there'll be a type of underwriter that will say they want they want a closed underwriting. Now, what is a closed underwriting? A closed underwriting would say if ever they're gonna be taking a thing, what you call 50% of their underwriting, whatsoever the case, they want to say if ever it happens that the public oversubscribes to the shares, what will they do? If they oversubscribe to the shares, they want their shares to be put first before the public shares, right? So now let's just assume now in our situation, so now let me just put this here, put them first in case of oversubscription, subscription. In case of oversubscription, put them first in case of oversubscription. So now let's just go back to our example again and say they were willing to cover 50% of the shares, right? Since they were willing to cover 50% of the shares from the get-go, now what would happen is that it means that the total value, and then we received applications from the public to say now they actually want to pay for the shares, and then the public actually takes all of the shares, this whole of that 1,000, right? So now if the public takes this whole 1,000 of the shares, what will the underwriter say? If ever it's a close underwriting, if it's a close underwriting, if ever it is a close underwriting, what will happen? Okay, excuse my English, it's fine, you guys know what I mean. Okay, fine. If ever they get a close underwriting, they will say now we want 50% of this whole 1,000 rand first before you give any shares to the public, right? So now if ever the public goes and say they are going for to subscribe to 1,000 shares, but we need to give the underwriter what, the 50% of the shares, which is 500 shares. So now what will happen is that now we'll have to go and say fine, before we give the public anything, it means the shares that we actually have as people that want to subscribe to at this point in time is 1,500 shares, right? It's this 1,500 shares. So now we will first give the underwriter first priority, which means the underwriter will pay us, or the value of the amount that they need to pay us will be what, 500 shares multiplied by what, the value of the shares, which is 5 rand per share, and then multiplied by okay, that's that actually, 500 per share, and then from there also they will still get their commission as thing as required. So their commission will still be what you call 50% of the shares, which is 500 shares. Gonna say 500 shares multiplied by 5 rand multiplied by how much, that 2% commission of theirs, right? Actually entered an extra zero there, and then the same commission will still apply, and then the amount that we'll receive from the underwriter will be what, the amount we'll receive from the underwriter will be this thing, value of the shares minus the underwriter's fees. So it will be 2,450, and then at this point we will just give the public the remaining 500 shares and repay back the money to the other shareholders, or actually applications that actually came in, and return the money to those customers, right? This is the advantage of them choosing to be a closed underwriter. But if ever it was an open underwriter, this is the situation that they will face, right? Whereby we only cater for the public first, and then their shares will actually come in afterwards. That's the situation that we'll be dealing with. And then okay, regarding marked and unmarked shares, I think that's out of your scope for now. We'll cover that on a different type of video. There's marked shares and unmarked shares, which are in marked shares. It's whereby it is a stamp of the underwriter that it is XYZ company or XYZ Limited that is underwriting these shares, and it makes it much more easier for us to actually allocate the shares before they're even sold, so that we can do our application and allotment properly, instead of the thingy of the unmarked underwriters, whereby It's only to the public, and we do not know who might actually purchase, make any application and allotment to us. So that's the situation. So, but we'll deal with that later. And then that's what I wanted to cover for this particular part of the video. And then now let's actually get into the question, right? And then every other lesson that you need, that's going to be important to you guys, I'll just include it along the lesson along the way. So now what do we have? We are told to prepare the following journal entries, including cash transactions, to account for the transaction in the records of Olympics Ltd for the year ended 29 February 2020. This is our current year end, right? So we already know we've got the year end now, and then now journal narrations are not required. We're like, okay, fine, no narrations. Clearly indicate which component, part and or item of the financial statement that will be affected by any journal entry. Statement of profit and loss, SPL, SFP, OCI, and statement of changes in equity. All right, fine. Then let's go to the question. Now, what are we going to do for A? We're going to go and generalize the receipt of application money, right? So now you go and check the receipt of application money. And then let's go and read the information here. Okay, the following balances appeared in the books of Olympics Limited as at February 2019. So this is the beginning of the year, or the previous year, end of the previous year, right? So now that's our situation. And then what we have, we had ordinary shares of which of 160 shares which were issued with the value of 820,000, and then we had preference share capital of 100,000 shares for the value of 200,000, and then we had retained earnings of 115,000. The following is an extract from the notes of the financial statement at 28 February 2019, right before the beginning of the year. Notes to the financial position, share capital. So now we find out more information about our share capital, which how much are we actually authorized to actually issue. Authorized share capital means that there are number of shares that we actually authorized to issue. So if we can never exceed 1,000 shares, we can never issue more than 1,000 shares, a million ordinary shares, and we can never issue more than 500,000. I think what you call 500,000 preference shares, right? And then it's fine. And then also find out that the preference shares, they are thing redeemable. Okay, that's fine. Also, they get dividends of 10% every time dividends are issued. Now also regarding with preference shares, know one thing: preference shares are given preference over ordinary shares. It means if ever there is dividends that are being issued, preference shares will be paid first, and then ordinary shares will be paid afterwards, right? That's the advantage of having preference shares, but you might be limited in terms of the right that you have in the company or decision making. So you might be excluded on that, but you get your money first before the other shareholders. So that's another thing. And the disadvantage is that the dividends will always be fixed to 10% also as well. Okay, and then let's go in. Then additional information, right? Additional information. The company offers a further 100,000 ordinary shares at 7 rand. So now the company is offering what to the public? 100,000 ordinary shares at how much? At 7 rand, right? And then they're also offering what? 50,000. Let's put in that 50,000 in there. They're offering what? 50,000. 50,000 preference shares at how much? Rand 50, right? And then 2,000 9% debentures of 100 rand each at 95% of to the public. Now this will trigger certain issues. So now it means we are offering these debentures at what? At a discount. Instead of the public paying full 100%, which is 100 rand, now the public will actually be paying 95 rand, right? So that's another issue we'll have to deal with when you get into the question, right? Okay, fine. Let's say 2,000. Let's highlight the debentures. There we go, at 95%. And then this is on what? On 15 July. The full offer is underwritten. You see the full offer. also at the very same time. It's underwritten by Schumann, what, LTD, right? So Schumann LTD is our underwriter. Fine, at a commission of 2.5%. The closing date for the application is 31 July 2019. And then we find out what is happening on additional information. The following application and the following application and application money were received: 85,000 ordinary shares, which means this is the portion that was purchased by what, the public. And then we also got what, 60,000 preference shares applications, and then also got 1,500 debentures applications. So now if you start comparing, you go and see that no man, with the 85,000 ordinary shares, it means now we have what will trigger the situation of the underwriter, that they actually we said we had offering 100,000 shares, but actually the public actually paid for what, 85,000 shares. So now that is what, 15,000 difference, or from 100,000 to 85,000, 15,000 difference, which is going to be paid by the underwriter Schumann Ltd, right? That's number one. And then for the preference shares, what do we have? We have 60,000 over here. This 60,000. Now what does this tell us? This 60,000 tells us that we were offering 50,000 preference shares, but they paid for more. So the preference shares were what, oversubscribed. So now this extra 10,000 that's here, we have to return it to the public, right? So in this case, the usage of Schumann as being an underwriter, since it is not a closed thing underwriting, we will say, nah, it's fine, Schumann, you don't need to pay us anything. The public took everything, and we are fine. I hope you guys are fine with that. And then what is also there, we also had debentures for 1,500 applications. And then how many applications were we offering? 2,000 applications. So now this is an underwriting also again. So now we go in there and say this was underwritten, and then let's put in that blue marker in there. Then now we're also told all the shares and debentures were allocated at 31 August 2019, and the underwriters fulfilled the terms of the agreement. So they paid their money also on 31st, right? So now let's go. The closing date of the application was 31 July. So now on 31 July, this is what had happened. We had already received the application. So on your journal entries, remember you have your date here to keep track maybe of everything if you want. And then you have your details. And then also as well, let's just put it over here. Then you'll have your debit here and your credit. I'm just gonna execute folio in this scenario, and then the date is what, 31 July by 2019, right? And then now, what is the first transaction? We need to allocate this 85,000 ordinary shares, the money that we received from the what, from the public, right? So now the money we received from the public, we received it in our bank account, which is bank SFP. We go and say 85,000 shares, 85,000 shares issued at how much? At 7 rand per share, 7 rand per share. And then we go in there. This is the amount that we received from the public. And then also at the very same time, we recognize the what? The liability from the thingy, from the underwriter on the state. That this, when this had happened, we recognize the liability from the underwriter of the remaining shares, which is how much? We're going to say underwriter. And then the underwriter is going to be a liability, an asset to us, since they're going to pay us. So now we expect to receive how much from them? Expect to receive the difference between the two, which is what? 100,000 shares minus 85,000 shares, which is going to be your 15,000 shares. At what rate? At 7 rand per share. Then we've got that in there, and then we're good to go. And then you go and say application and allotment. Okay, forget the English, it's fine. This is a liability that we have to the public, since the shares have not yet been given to the public, right? It's still applications, they have not received any shares. So now we're like, okay, fine, let's put this in, and then this is the sum of these two, and then 700,000 that we actually received for we are planning to receive for thingy, what you call for ordinary shares, right? At this current moment, it's a liability. And then number two, you go and say, you go and account for what? The preference shares. So for narrations, let's just say share capital here, share capital recognition, even though they did say it's not, narrations are not necessary, but then for you guys to be capable of keeping track of everything, I'm just going to do something like that, right? And then over here, we're going to go also again and say 60,000 preference shares, and then you're going to say bank SFP, right? And then you received how much from these people that were purchasing preference shares? You received money for 60,000 shares, going for how much? For R3.50 each, right? R3.50 each, R3.50. So this is the amount that we actually received from them. And then we're going to put this in the application and allotment account. Application and allotment account. And then there we go. Okay. Put in this 210,000, and then now we're gonna go for what? The debentures. Now take note on debentures. I want you to be on watch when you get there, right? Okay, fine. Let me just narrate this. Preference shares, preference shares, recognition. All right, fine. Just do it like that. And then what do we have with debentures? We received money from in the bank account also as well. SFP. And then how much did we actually receive from the public? We received 1,500 debentures applications, which gave us how much they paid for. How much they paid for 95 for thing 1,500 debentures at how much? At 95%. It means it's discounted from being 100 rand, right? So now like, okay, fine, let's go with that. So now supposed to be paying 100%, but they're gonna pay what? 95%. Okay, fine, we get that money since it's discounted. But now also you have to take into account that, okay, who else did we have on the thingy, on our share, on our thingy? We had an underwriter, right, for what? The remaining shares, which is what? The difference between 200 and 1,500. So now we had our underwriter, SFP, our thingy, our asset here at this point, our receivable. Let's just put receivable here. I think it will be very important that we do that. Underwriter, receivable. Yes. And then okay. Forget the spelling. It's fine. And then underwriter, receivable. And then how much are they gonna pay us? They're planning to subscribe to what? 500 shares. At the amount of what? 95. Okay, let's say that 100 multiplied by what? 95%, right? They're planning to subscribe for this amount. But now, since it's debentures, as much as that these people are actually paying 95% of the value, whenever a debenture, remember at this particular point, a debenture is a loan. It's not the same as thing share capital and preference shares. Debenture is a loan. It goes under liabilities directly. These ones will go under owner's equity, the share capital and the preference shares. This one is a liability. So now, whenever we need to pay these people, we need to pay them their thingy, their amount, which is going to be 200 shares multiplied by 100 rand, despite the fact that we actually gave them a discount. So now, what do we do to recognize this in our books? You go and say, okay, fine, debentures, discount, right? And then this will go into our what? Our SFP also as well, right? But now take note also again, debentures discount is a what? Debentures discount. Let me just, yeah. Debentures discount is a contra liability. Debentures discount, it's a contra liability. So it's almost the same thing as how can I put it, accumulated depreciation to some extent. So now this will be offset always against what the actual debentures that will be actually issuing, right? And then we will amortize it until we actually return the value of the discount back into the what the full value of the debentures on the statement of financial position in the liabilities section. So since now I also want you to take note, let me just finish this transaction first. I'm gonna say fine, these people are subscribing to what, 2000 shares, but these 2000 shares, instead of them being sold for 100 rand, they are being sold for 95%. So now we want to take into account what, this 5% discount, right? This 5% discount. So this discount is what, 10,000. And then the actual debentures, oh sorry, it's actually still application and allotment in this case. Application and allotment. And SFP, this is a liability at this point. But now we'll talk about this. Okay, let's actually just talk about it now. Let me just finish here. Then this will be the sum of this 200,000, right? So debentures are a contra liability. So also at the very same time, if ever after we allocate this thing, the application and allotment, and then we recognize the actual debenture, which is going to be a liability value, it's going to be appearing on the statement of financial position on the liabilities section. But the debentures will appear, debentures on SFP appear at face value. No, actually not face value. I think what you call carrying value. Carrying value, right? Because at the end of the period, when we are paying our supposed to pay our thing, our lenders, the people that purchase the debentures, we're supposed to pay them at what? Pay at face value. So now the difference is that debentures are at carrying value. Debentures at carrying value, it's what? Now let me just do this. Debentures at carrying value, it's this actual thingy, actual money received minus discount. That is the carrying value of the thingy of debentures. But the face value will be what? Face value, it's what? Uh total debentures, total number of debentures, number of debentures total number of debentures times any their issue price, which is what, 100 rand, their issue price. Then also over here I should fix this and say instead of saying actual money received, I should actually just say total number of debentures times their issue price less that discount minus any the discount. So now I hope you know the difference between debentures at carrying value and debentures at face value. So now when they appear on the thing on the SFP, they appear at what, at carrying value. But at the end of or at the period, at the end of the period when we are supposed to pay the debentures, we'll have to, they'll be appearing at what, at face value. And I will show you the way forward on how to actually do the right procedure to actually make sure that it's actually the right amount at the end. And that's why we end up amortizing and stuff like that, amortizing debentures, especially discounts and stuff like that. which is an amortization will be the expense of actually having this debenture also as well, which will mean we are actually increasing the interest expense, even though it's not a cash transaction. You'll see when we get there, right? For now, be on watch. Then now, after this has been done, this is the allocation. We have answered what the receipt of application money, right? So we received the money and created the debt that is there for us.